You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
All right, everybody. Welcome back to Options Playbook Radio, the program here on the old network where we break down the sometimes scary, sometimes impenetrable, sometimes just fun world of options into some offensive and defensive plays that you can utilize in your own portfolio. My name is Mark Longo from the old OptionsInsider.com, as well as, of course, from the old Options Insider Radio Network. If you're listening to this saying, hey, that's not the guy I thought I was going to hear today, you're correct. So let me toss it over to your usual host, Mr. Brian Overby, the Senior Options Analyst, a.k.a. the Options Guy, over there at Ally Invest. Brian, welcome back to your own program, sir.
Well, it's great to be back. And as always, I love when you're able to help me host the program, because that means that we get to answer some listener questions. And all we have to do is just huddle up.
It's time to huddle up and answer questions about your favorite options plays. Submit your questions via questions@theoptionsinsider.com, twitter.com/options, facebook.com/theoptionsinsider, or via the Trader Network at tradeking.com.
All right, everybody, welcome to the Huddle. Like Brian said, this is the portion of the show where you guys take the reins. Brian, I hope you settled in, because we're planning, 3-4 hours of an options question palooza? That what we got going here today?
Yeah, I'm ready. Bring it on.
We certainly got enough questions to go.
I got enough coffee.
There we go. There we go. We got a lot of love here for the show. Let's kick it off with some love, Brian. It's always fun to do that. We got some love here.
Well, it is Valentine's Day tomorrow.
You're right. That's true. Here we are, getting love from the listeners. How appropriate. Let's kick it off here with Georgi. Georgi is following up. He actually had a question he said on the last huddle. He says, hi, Brian. Thanks a lot for taking the time to elaborate on my question about out-of-the-money calls on the January 17th episode of Options Playbook Radio. You guys are doing a great job. I'm listening to you since while I've been listening. I think it means I've been listening to you since while, and I am very pleased with the content and the way you present it. I enjoyed how you also enjoyed how you tried to pronounce his Yahoo nickname of Joro. His name, in fact, is Georgi, or just George in English. So thanks again. Cheers, Georgi. Well, there you go, Brian. I remember that name. That handle sounds familiar, Joro. But yeah, there you go, Brian. Some love for the show. I always love new listeners coming in, discovering the show, and then they have a great back catalog they can go back and check out kind of at their leisure. But still, Brian, it's always nice to kick off this Valentine's-themed episode with a little bit of love. What do you think?
Yes, yeah. Well, thank you so much for the correction. I always like to correct mistakes because we're human, just like everyone else, especially trading options. And that's part of the reason why we love option trading, is because we can manage our risk and try to make up for our mistakes. So I appreciate the kind words. And, I'm sure we'll answer a few questions for Georgi going forward.
All right. Next up, we've got Dave. Dave B. He says, hi. Well, hello, Dave. I have a question about what is the best strategy to use for my trading system. I typically am only right on about 3 or 4 trades out of every 10 with long stock. The trades that I am wrong on, I take a small loss, somewhere between 5 to 10%, but only about 1 to 2% of the total capital, as I typically take 10% positions. The trades that I am right on, I typically make 50% up to 200% over a 3 to 12 month period. Interesting. He goes on to write, I want to find an option strategy to increase returns via leverage, but keep total portfolio risk per trade about the same. Would deep in the money calls or spreads make sense to you, or is there another strategy I could or should consider? Thanks, Dave B. This is an interesting one, Brian. He's got an interesting little system here. He admits by his own admission he only hits it right about 3 or 4 times out of 10, but when he does, sounds like he makes it pretty good. So I guess he's making up for on the winners here. He's letting them run, which is a good thing. So he's got risk management on the losers, which I like to see, and he's letting his winners run, which at the end of the day is the name of the game. So if you're working it out this way, even if you're not right all the time, still, if you're cutting your losses and letting your winners run, you could make it up at the end of the day. Interesting question here, Brian. What is the best option strategy for it? I think his suggestion, he starts at an actually a good place, a place that is near and dear to our hearts here on Options Playbook Radio. I don't know if you know this, Brian, but we kind of like stock substitution. You like the old fig leaf, which is another flavor of stock substitution. That's pretty much exactly what he's suggesting here. Deep in the money calls, that is effectively a stock substitution type strategy. We typically recommend it somewhere in the 3 to 6 month range, somewhere around a 65 to 75 delta. But again, your mileage may vary. Remember, the farther out you're going, the more expensive that call is going to be. So it's going to make the leverage, the amount you're making up in terms of capital efficiency, going to be a lot less. So you're going to have to put more capital to work, which at the end of the day is what you want to do. You want to kind of free up some capital to maybe do some other trades and things along that line. And then, Brian, he can, of course, augment it with your old favorite, the fig leaf, which is coming in, doing the short front month, not quite covered call, but kind of covered, hence your name, of selling a front month out of the money call against that deeper, longer term in the money call. Is that your preferred MO for Dave here, Brian? Would you like to see him maybe do something else?
Well, yeah, you covered that extremely well. So we'll just say, yeah, that's an option. And then he said spreads, and I don't mind looking at spreads either. We don't know exactly what strategy he's doing, but obviously if he's doing what he says he's doing, first of all, you'd probably just keep doing it because it sounds like it's working out fairly well. The other thing would be when you look at spreads, you can totally manage that risk. And I can go out and a spread in particular that I'm thinking of is a long call or a long put spread where I am buying one more expensive option contract and selling a less expensive option contract. Now, based off of this, though, I'd be looking at doing them a little bit out of the money. And that's mainly because you can manage the risk. You could say, I'm going to go, I don't know how he's picking his stocks, and that always makes it a little bit tough. But I go a little bit out of the money, and I can do maybe a 2.5 point wide spread and pay $75 for it. So 75 cents on a 2.5 point wide spread. I'm managing the total overall risk to 75 cents. On the upside, I can make a maximum of $2.50 minus $1.75 or $1.75. Now, I'm just picking numbers out of the air, but that would be a scenario where I'm going to say, okay, if I'm correct on my forecast, I have potential to make $1.75, and if I'm incorrect, the most that I can lose is 75 cents. Now, what's nice about that is you got those risk parameters already in there. And, you can't make more, you can't lose more, so you're never going to mistakenly hit a home run, right? But you got the risk managed. And if you're being very disciplined on when you are taking your profits, which it kind of sounds like you're doing, I would definitely look at spreads. And I want to stay fairly close to the expiration. So I'm looking at 10, 17 days out, especially if you're doing this. I kind of feel like he's a chartist, but I'm not quite sure. If I'm doing it based off of a chart pattern that I'd see, that's one way to look at it. And just manage the risk using the spread. So we gave you two fairly decent scenarios here, but I like them both.
Yeah, I mean, there's so many different ways we can go with this, right? We can go crazy. We can say, bullish risk reversals. We can say bullish verticals, financed by all sorts of crazy things. But I think he sounds like he's comfortable with long stock. I think, the in the money stock substitution is very analogous to that, so it won't be a big leap for him, pun intended. And so he should probably be comfortable with that. Then you're right. He could certainly graduate towards the verticals, and those have a nice defined cost and a defined payout, and that's something you can keep an eye on as well. So when you hit those high flyers, it'll work out interestingly for you. But interesting stuff here. What was it, Dave B? I think you kind of hit on your own suggestion. That's a good way to start. Then of course you can graduate to some of the more advanced strategies. And again, Options Playbook, going from episode 1 all the way through to now. You listen to those. Hopefully you have. Sounds like you have listened to at least a few. That'll get you up to speed on some of the great ways to do these more speculative type trades without spending a ton, without risking a ton. Which is, again, the name of the game. You want to be in there at the table, managing your stakes until you can really hit a nice pot there. All right, let's move on here. Whitaker asking a little more love here for you, Brian. You getting this? This is definitely a love fest here for you. He says, I like all of Brian's earnings strategy episodes of Options Playbook. Well, there you go, Brian. Getting all the love.
There we go.
He goes on to say, it seems like Brian prefers to use skip strike butterflies whenever trading around earnings. But are there ever times when he will utilize other strategies around earnings? Maybe a straight long short call or put when he feels there is an edge. Good show. Loving the Playbook website as an addendum. Well, there you go, Brian. More love for the Options Playbook website, which we don't talk about a ton here on the show, but listeners can obviously go there and check all this out while they're listening to the show, or maybe in addition to listening to the show if they want to reinforce something. It's a great way to get additional info if you have questions about all this stuff. But Brian, it's a good question. He's asking about your earnings trades. Obviously, we're kind of in the midst of earnings season now. You've been doing a lot, just talking NVIDIA and PepsiCo just on the recent last couple episodes. You like your skip strike flies. He's asking if there are times when you'll go out there maybe a little bit more straightforward, maybe just buy a call or sell a call or a put. I'm going to answer probably that part, probably no, but maybe a vertical, maybe in your case a simple vertical. You ever times you're doing those?
Yes, and well, here's the way. The biggest thing about the Playbook Radio show is to realize that we got 40 different plays in the playbook, and talking about a long call would get boring if we did that every week. So we don't bring it up that much. But I probably should do an episode just about when and which option to buy when you're looking to just buy, because there are different ways to approach it. And I'll say it this way. If I were to buy a long call around earnings, I'm usually going to do something that has less susceptibility to time decay, which means they're fairly expensive options. I would go a little bit deeper in the money, and I would buy more intrinsic value than I would time value. And so the reason why I don't talk a lot about that is if you go a little bit deeper in the money, they're usually a little bit more expensive. But maybe on a lower price stock, maybe if I was doing it on a $50 stock or a $40 stock, I might be willing to buy an in-the-money call because I'm bullish or an in-the-money put because I'm bearish. But that would be on lower price stocks, so I don't have to put up quite as much capital. Obviously, if we're talking about NVIDIA, which Mark brought up, $150-some stock, I don't think there's ever a scenario where I would play that, unless I had insider information, straight long call or straight long put, right, overall. And then, you could, if you feel like there's an edge, selling a short put spread or selling a short call spread way out of the money, that is feasible. That's feasible to do around an earnings that you just think the ball is just extremely high relative to what it's been maybe the previous 3 or 4 earnings, and you want to try to take advantage of it. That's not out of the picture. I like that scenario better than buying long calls and long puts overall, though. And thank you so much for the kind words. And yeah, Options Playbook website, check it out anytime. And also you can check out Options Playbook in Amazon. You can buy the Kindle version too. So there's many different ways that you can get the playbook. So I appreciate you using it as an addendum to the show.
Is it back on Amazon? I know it was sold out for a while. Can they get it again?
Yeah, it's going to be back full time here very, very soon.
Oh, great news.
They're negotiating it. Yeah, they got it. Every time we get a new printing, you got to have a new URL or whatever the heck that thing is. UBC.
Of course. But hey, can you imagine if we did every episode was just long call? Long call on IBM. Long call on SPY. That's not the reason we don't do it, listeners, but it wouldn't exactly be the sexiest show on the planet either. Long call this week. All right, let's see. We got a lot more. How many we can squeeze here? This is a timely one. Leg 77 says MIAX, or the Miami Options Exchange. They're making it official with 16 options exchanges. What do you guys think about more players entering the options game? Yes, MIAX making it official recently as well, coming out with their third, I think it's going to be called Emerald, I believe. Either way, it gets us up to 16 exchanges. This is a topic we talked about before, kind of fragmentation in the option space. Let me maybe clarify something for you, Leg 77, other listeners out there who aren't familiar. These are new exchanges because they're new medallions. They're approved by the SEC, so they're exchanges in that sense of the word. But in reality, what's going on here, I think if you talk to the folks at MIAC, just about any other exchange, they'll say this, and I have talked to all of them behind the scenes about this very topic. You know, I think most of them, outside from, let's say, the SIBO, who just acquired a bunch of exchanges, they obviously want to have different medallions. But at the end of the day, most of them want to be able to offer different functionality to different players in the option space. And so it's a case of maybe having and different pricing structures as well. And that's the issue. The SEC comes in and it really says you can't charge different prices for the same asset on the same exchange. What they have is one quote-unquote exchange where they're using what's called, let's say, a maker-taker type pricing system. And they have another quote-unquote exchange, same matching engine, same connectivity, really it's just a different license. And now they are able to give you rebates on a different exchange and vice versa. So it's all really about pricing and market structure, maybe a little bit of latency and technology going on there as well. So while these are all termed exchanges and they're viewed as that from the SEC's perspective, in reality, it's not like MIAX really has three separate independent entities. They all use the same matching engine and everything else. It's really just a question of offering different rebate and fee structures and allowing them to be able to cater to different markets in the option space. And until the SEC changes that ruling, and it doesn't seem like they're going to do that anytime soon, I don't think we're going to see the end of it. Probably going to see more exchanges, probably rather than fewer, as they keep trying to find different segments that are of value to particular exchange, and they want to target it. And then they're going to probably spin up another thing is it doesn't cost a lot. The same matching engine, the development isn't much there, so it doesn't cost them a lot to spin up a new entity, and that they can target a new model. And if the revenue is more than whatever the startup and operating costs are, they're going to do it. So that's pretty much why we're seeing all this stuff. Brian, you interact with the retail on a daily basis, obviously, and obviously I think the fragmentation may hit home for them. What are your thoughts on the continued fragmentation, sir, of the option space?
Well, first of all, that was a great explanation. I actually kind of learned something about that little bit from just listening to you.
That's why I get the big bucks, sir.
But I guess the biggest thing, I would like less fragmentation. The technology is there that they can now quote almost unlimited products. And because of that, we're seeing so many new products come to the market. We're seeing half-point strikes. And I just think it's getting a little crazy. I just would like them to actually stop and let this liquidity that could be in the marketplace happen. Because I think if anything in the options world, the one reason... Well, let's put it this way. Let's just look exactly at buying deep in the money leap option contracts, long-term option contracts. I think everybody in the world would be doing fig leaves and buying all those 80, 90 delta calls if they just had real tight markets. I mean, if you get outside of the top 10 stocks, it gets hard to do those type of strategies because the markets are wide. And it's mainly because we're inviting all these new products in, and new products draws liquidity away, and when that happens, the good products suffer a little bit from that. So, yeah, fragmentation. But I did love your explanation, just overall as to why all these exchanges are popping up. But overall, I would like to see a little bit more of the consolidation, a little bit better liquidity in the marketplace overall, and all these new products that are just coming from everywhere just kind of hurt things overall, in my opinion.
Yeah, it does make it hard for the savvy retail guy who starts trading spreads, and then they start learning about spread books and having to execute across those. And yeah, there's a lot of downside for a lot of the audience out there as well when you're talking about these issues. It's a very murky Very interesting issue there. All right, since we're talking so much love, let's not end on murkiness, Brian. Let's end with some more love. Let's see. It's a Valentine's themed show, so why not? We got a 5-star review here from Jake. I don't know what platform it's on. It says, great content. Thank you. Well, you're welcome, Jake. And then let's end it here with Lacroute 2, actually. Number 2. He says he funded his Ally Options account, and he's enjoying the Options Playbook program. Well, you came to the right place, Lacroute. He goes on to say, I'm thinking about picking up the book as well. Look at all the love here, Brian. So, Brian, it's an Overbee Love Fest here today. He goes on to write, we need to have Brian and Mark do a regular show for the Ally Options folks so we can listen to while we're trading. Oh, that's an interesting idea, Brian. What do you think? Me and you beaming at the Ally folks every day. That'd be crazy.
Well, yeah, I wouldn't be opposed.
Well, there you go. Lacroute 2 from your mouth to perhaps the folks at Ally's ears. So we are kind of doing a regular show. Brian and I don't get to do it together as much, but it's fun when we do because we get to answer questions like this from Mr. or Mrs. Lacroute and all the other folks on. I was joking at the top, but we really could go on for quite a bit with all these questions. Love the questions. Keep them coming, listeners. Brian and I will try to huddle up more to get your questions featured on the program. And Brian, before we go, if listeners want to do what Mr. or Mrs. Lacroute 2 suggests, they want to maybe open up an Ally account, or maybe they want to check out the playbook on the website version or on the Amazon version, or maybe more importantly, maybe they want to ask a question just like everybody else here did on the show today. Where should they go? What should they do, sir?
Well, I want to encourage, first of all, Mr. or Mrs. Lacroute, too. Please send me an email. I love the fact that you've opened up an account with Ally, and I would just love to chat with you over email. So that address is theoptionsguy@invest.ally.com. It's the options with an S guy at invest.ally.com. And I want to say thanks to Mark and everybody else for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
I just realized we didn't pick a winner. I always forget. Actually,
I just thought of that. But, I'm going to send him a playbook, because he can't go buy one. So I'm going to send him one.
Okay.
This guy, if he emails me. But I don't want to say that over the radio.
Okay, well, we can just leave it then if you want, and we can just do it again next time. Or we can pick a winner and then cut it in. Your call.
Okay. Do you want to cut it in and just say, that makes you the winner this week. Thank you for opening the account, and maybe we just say that.
Okay, go for it. 3, 2, 1, go for it.
All right. Well, I think that was a great way to end it, Mark. And Mr. or Mrs. Lacroute, too, I think that's going to make you the winner of the Options Playbook for this Huddle Up. The fact that you opened up an account and you gave me some great love here, I'd love to send you an Options Playbook because you're actually thinking about buying one. So why not? Let's just send it away. What do you think, Mark?
I love it. And I love all the listener love. Thanks for all of that on this Valentine's themed edition. And we'll see you back here next time for more Options Playbook Radio.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.